what would you be telling Jay Powell right now?
Oh, I'd be saying look for another job. I think this is one of the most challenging periods ahead for the Federal Reserve Board in its history. And it's certainly something that I don't know if we've ever navigated anything like this, but we've just never seen anything like this since the 70s. So it's really uncharted waters. I like to think of it as a crosshatch ocean. You know how normally in the ocean you'll have one swell that moves one direction. Occasionally you'll get a situation where you have one swell moving in one direction and then another swell coming cross-hatch, and it creates this impression of squares in the ocean. So imagine trying to navigate that when you're in a boat where you're dealing with the swell this way and this way and this way and this way, and that's what we've got right now. If you look at how much financial conditions index has tightened just in the last month, the only other times that it's tightened this much, and just to remind everyone, financial conditions index is a composite of the stock market, the dollar, credit spreads, and it's a very good indicator of the general strength of the overall economy, a good proxy for it. So it's moved so much in the last month. The only other two times I think that exceeded it were in Lehman Brothers in 2008, as well as in March of 2020. Every one of those instances were all associated with cuts, Federal Reserve Board cuts, within 24 days on average. Literally, some of them within 2 or 3 days. Now, all of a sudden, we've got the same kind of reaction in the markets, which is clearly a risk-off. Credit spreads have blown out. Stocks are down 13% in the year. The dollar's up significantly. All that normally has provoked or evoked a Fed response of cutting rates, and yet we're probably on the cusp of 200 basis points of rises. It's uncharted territories where we're going. Again, one of the reasons, I think maybe the biggest differentiator between now and those other periods over the past 40 years is look at the level of overvaluation that we were both in rates as well as stocks. So that's one reason why even with this tightening in financial conditions, the Fed still probably has to raise rates to get inflation under control. Heck, we had CPI greater than 8%. Maybe it comes down to 4% this year. Maybe it comes down to 3% if they stay the course and stay tight in 2023.
Do you look at that, Paul, and say to yourself that a recession is coming? Do you say everything's on sale, I got to buy things? Do you say that I got to short this market? I mean, I know you say you don't have a strident view, but you must be telling your traders
clearly
to do
you
something.
Don't want to own bonds and stocks. You start with that. It's going to be a very, very negative situation for either one of those asset classes, right? You can't think of a worse macro environment than where we are right now for financial assets. If you've got inflation greater than 3% on average, your purchasing power declines, cuts in half in 13 years. It's why I wish we could go back to those halcyon days of sub 2% inflation when you didn't have to worry about the value of your money. You didn't have to worry about what you were doing with regard to pay raises, and you didn't have to worry about a whole pricing, a variety of things that all of a sudden become that much more important. And trying to, again, just have a normal business that you have to think about when inflation's 3% and higher, and you don't have to think about when inflation's 2% and under.